Have you ever noticed that retirement planning feels like you're navigating a financial maze without a map? You take a step forward and then the market shifts. You turn a corner and a new tax rule appears. You throw out the wrong strategy and you just come back empty-handed, hungry, and frustrated.
And when you're planning for a retirement that could last 20, 30, or even 40 years, you can't afford to get lost. Today we're showing you the right tool to navigate. Sometimes it's an annuity, sometimes it's not. Grab a life vest. Let's chart a course.
I'm Jonah, and he's Jeremiah, and together we're the Banking Bros. We translate money speak into plain English so you can live on your terms, not Wall Street's. The financial world is full of jargon and complexity, but our goal is to simplify it so you can make confident decisions.
Retirement income isn't one spigot, it's a circuit board. A good system has multiple wires, each powering a different component of your life. Your wires include Social Security, maybe, 401k drawdowns, whole life cash value from the save and spend system, rental checks, and yes, sometimes an annuity that pumps guaranteed cash even when markets turn sour. You don't need to just rely on one source. You need to build a system that works for you.
Today, we'll map that system. We'll pit immediate and deferred annuities against 401ks and taxable brokerage accounts, and then we'll test two real-world scenarios. We'll show you how a 55-year-old can strategically use an annuity to turn uncertainty into a rock-solid plan. And this isn't an ad for annuities. It's just an education on when this powerful tool can fit right into your retirement toolbox. So let's get to the blueprint.
First, you have to build safety. That basement level of your financial house is the money that must show up, rain, shine, or recession, to cover your non-negotiable expenses. We're talking about the bare minimum: groceries, utilities, property taxes, your health insurance premiums, and your medication. Social Security helps, and it's a powerful tool, but it rarely fills the whole basement. The gap is what keeps most people up at night. The goal of your retirement plan is to make sure this basement is completely covered by guaranteed income streams.
Second is you build your lifestyle. This is the fun stuff, the travel you've been dreaming of, the hobbies that you never had time for, right? The new car that you want, and all the money to spoil the grandkids. These cash flows can flex with the markets. This is where your 401k drawdowns live, your Roth conversions, and even strategic policy loans from your own save and spend system. If the market has a bad year, you might take one less trip, but the bills in the basement are still paid. And this is part of your plan that has the most freedom.
And finally, you build your legacy. This is what you leave behind: gifts to your kids or grandkids, a donation to a charity you believe in, or simply a paid-for funeral so nobody has to launch a GoFundMe to cover your final expenses. This is where the death benefit from a life insurance policy lands, tax-free. The money you build in your life can also protect your family's financial future, and a well-designed plan should have a component for this.
Understanding this blueprint is the key to knowing where an annuity fits. It's not for the lifestyle and it's not for the legacy. It's just a tool specifically designed to build that floor, that basement, to guarantee that your non-negotiable expenses are always covered, no matter what happens in the world. So, what is an annuity really? Strip away the jargon. An annuity is just a contract with an insurance company. You give them a lump sum of money, and in return, they give you a guarantee. That guarantee is a stream of payments for either a set period of time or, my favorite, the rest of your life. An immediate annuity is a lump sum trade for a pension-like paycheck, an immediate paycheck that starts within 30 days. A deferred income annuity can start a year later or 10 years later. A fixed indexed annuity credits interest, which is tied to an index, but a lot of times it'll never be below zero, which is pretty cool. All of them share one superpower. It's guaranteed income, and it's backed by an insurance company's balance sheet.
That guarantee feels like a warm blanket when the market gets the flu. What you're really doing is transferring risk. You're transferring longevity risk, the risk of outliving your money, to the insurance company. You're also transferring sequence of returns risk, which is the risk that a market downturn early in your retirement will devastate your portfolio. This is the biggest selling point of an annuity. It's a tool for predictability, not for growth.
But here's the crucial trade-off. Once you annuitize, the contracts lock the money, right? So you're no emergency brakes. You're not coming back for the principal ever. What you're getting now is the income checks. And that's why I might suggest that you don't normally put your entire nest egg into one annuity. An annuity is a tool for a specific job. You build the ground floor, you build the basement of your financial warehouse here. You don't use a hammer for every single task in the house, do you? And you really shouldn't use an annuity for every financial need. So let's talk quickly about how a 401k and an annuity kind of compare to each other. Both a 401k and an annuity are designed to fund retirement. The difference is how they handle the sequence of returns risk. So here's what I mean. With the 401k, you slice off a portion so you can have money, right? Probably monthly, a lot of people do that. And if the market tanks early in retirement, then you're forced to hack off more of that money so you can just live off the same dollar amount. That means there's fewer dollars to rebound when the market actually recovers. And that is the nightmare scenario, because you'll actually end up running out of money in your portfolio. Even if the market recovers later on, your principal balance is just too low.
An annuity flips that risk to the insurance company. They promise the check, you promise to try to live. Live longer than actuaries expect, and you win the longevity jackpot. The check is the same every month, regardless of what the market's doing. That predictability is what allows you to sleep at night.
But trade-offs matter, right? Annuity income is taxed as ordinary income if you purchase it with pre-tax dollars, like from a 401k. And that means your income is taxable just like your paycheck. Now, if you've got a Roth bucket, wherever it is, a 401k, an IRA, if you draw that down strategically, a lot of times that's tax-free. And you've heard us talk about our favorite system we teach all over our channel, the save and spend system, which is policy loans. Those are also income tax-free. So it can reduce your death benefit until you repay it, but that's all just to say that you've got to consider your income stream, and not only your income stream, but the tax implications of that income stream.
Liquidity also tilts toward the 401k or brokerage. Need a new roof? You can withdraw. Maybe pay a tax, maybe trigger a penalty, but you can get it. Annuitize and the principal's gone. You can't get it back. That's why it's so important to not annuitize all your money and to have other liquid tools like the save and spend system that can be your emergency brake.
So let's look at this solo saver. So here's what I mean. There's a gentleman, he's 55 years old, he's single, he wants to retire in 10 years at 65 years old with $6,500 a month after tax. He has $650,000 in a 401k. He's got $120,000 of cash value in his save and spend system policy. He's also going to get about $2,200 monthly from Social Security when he turns 67, a few years away. He is a disciplined saver, but he's really terrified of a market crash right as he retires.
Option A, he stays market heavy. At 65, he moves to a 60-40 stocks, bonds portfolio, withdraws 4%, $31,000 a year, then adds Social Security at 67. If markets deliver historic returns, he squeaks by. If they crash early, he risks cutting his lifestyle by year 7. This is the classic high-risk retirement plan. His entire retirement is a coin flip, and he's terrified of what happens if it lands on the wrong side.
Or option B, at 63, he shifts $250,000 from the 401k into a deferred income annuity, and he'll set that annuity to start paying his checks at age 70. And he's going to get $20,000 a year for life. His remaining 401k just rides the growth or the market until he's 70. But he bridges age 65 to 70 with policy loans from his save and spend system, tax-free, flexible. He repays them gradually, maybe once the annuity and the Social Security begin, kind of up to him. But the result is 80% of his non-negotiable needs are guaranteed. And portfolio volatility now only threatens like the vacation fund, right? His anxiety is just gone.
Notice he didn't annuitize everything. He used an annuity to cement the basement level of the house, while the attic and middle floors stay investable. He used the right tool for the right job, and he didn't try to make one tool do everything.
Let's take a look at a different scenario. Mark and Ella, right? These are two people who have teens from prior marriages. Their combined income together, $180,000, and their plan is to retire at 60 years old and tour the national parks all across the states in an RV. They've got a little bit of a more complex financial picture, and they're worried about how their money is going to hold up for two people over that time period, right?
They fear outliving assets and fighting about money. They roll $300,000 from Ella's old 401k into an immediate joint life annuity today, locking in $1,450 a month for their lives. This annuity covers the RV payment, gas, and a portion of their food expenses. It's a guaranteed paycheck that allows them to live the life they want.
So Mark maybe keeps his 401k aggressive, maybe. At 60 years old, they just ladder portions into 5-year treasury notes, and they add a second annuity with a 10-year period certain, checks for 10 years. That creates like a pension staircase. Then they've got policy cash values that remain kind of their emergency fund. We've talked about that in some videos previously.
By 70 with Social Security, 2 annuity streams, and bond ladders maturing, they meet 100% of fixed expenses. Anything Mark's market account earns is gravy, or legacy.
Also, peace in their marriage, predictability on the road, and I think that's the human side of the math.
So when should you use an annuity? You consider an annuity when the fear of running out outweighs the thrill of squeezing every last return from Wall Street. When guaranteed gas in the tank matters more than horsepower.
Now, I'd say avoid annuitizing cash that you might need, right? Keep a strong growth engine alive, and you layer on tax-free tools like our save and spend system so the government does not eat all your guarantees for lunch, right? Your income. So if you're ready to engineer your own income circuit board, right? Basement to attic. Build this foundation and find out if an annuity actually fits your situation, then here's my request. Please hit the subscribe button. You can tap like, you can book a free strategy call, a consultation. It's in the link in the description of this video. We'd love to talk to you.
If you have other retirement plans, we'd love to hear them. Drop us a comment to this video and tell us what you think about income annuities. However, if you've made it to the end of our video, we should leave you with the idea that you shouldn't let randomness steer your retirement future. Grab the controls, build the plan, and keep banking on yourself.
Gave a lot of game, we never got a lot of things. Bow your head and say the prayer, we taught you how to be the bank.